Hi, I'm Jared Nelson from the Investing Channel, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. We have just finished the first trading week of a new quarter, and we're preparing for the dominant headlines of the Q1 2021 earnings season. Traders will be busy over the next month digesting the earnings data, assessing what management says in any accompanying conference calls. However, money managers try to look beyond the hype of earnings season. Yes, stock prices move on earnings, but often institutional investors are looking much longer term than just a couple of quarters down the track. Wall Street pros can't ignore earnings completely, of course, and they use the releases to test if their thinking about a company is correct, and to show if its management is able to execute the company's business plan effectively. Investing for the long term is also about spotting trends and track records that can play out over years or perhaps even decades, trying to identify which companies are best placed and best able to benefit from them. Sometimes those companies, like Apple and Google, will even invent new categories and marketplaces of their own, whole new areas of business that didn't exist before. These are businesses known as category killers, and if you have held these type of stocks for any length of time, then you are likely to have done very well indeed. Identifying, investing in, and holding on to a stock like this is no easy task though. Professional money managers have to hedge their bets and diversify their portfolios, rather than follow the all-in YOLO popular among social traders over the last 12 months. One way that institutional traders and money managers can try to combine stock selection and diversification is through the use of what are known as factors. Essentially, these are traits that are common to certain stocks and stock types. They include growth, momentum, low volatility, value, size, and quality. What money managers often do is identify which stocks exhibit particular traits and build portfolios of stocks that have the traits that they believe will serve them well in future economic conditions. The process is similar to the way that farmers try to pick crops that will suit the soil type, rainfall, and climate in their particular part of the country. Some stocks and sectors exhibit more than one of these factors, which means that it's possible to build portfolios that combine these characteristics, make them more robust and likely to flourish in a variety of conditions. Indeed, some of these portfolios are nicknamed all-weather portfolios for that very reason. Much of the debate in the markets over the last 12 months has been about value versus growth. Growth stocks have outperformed value stocks for several years and led equity markets higher after the COVID crash just over 12 months ago. Value stocks, on the other hand, have only recently started to come into their own once more, as investors look for stocks that will benefit from a reopening of the economy and return to normality later in 2021 or early in 2022. The argument about growth or value is often shown in binary terms, implying that you can only have one or the other. But that isn't necessarily the case. Growth stocks are also often momentum stocks, stocks that exhibit persistent trends in their price action. Or to put that another way, stocks whose share prices rise, and because they rise further, and so on. Momentum stocks can continue to do so as long as fresh buyers appear. It's this momentum that's led the S&P 500 and the NASDAQ 100 to all-time highs recently. However, value stocks can be momentum stocks too, and in fact, there is even an S&P 500 index that tracks high momentum value stocks, and it's up by 51.37% over the last 12 months and 16.36% in 2021 year to date. As investors, we are fortunate to live in the age of the ETF, and in most cases, if there is a specific index, there will be one or more ETFs designed to track the performance of that index. And that's very much the case here. For example, the Invesco S&P 500 Value with Momentum ETF does exactly that. The message from all of this to retail traders is that you don't need to be siloed or pigeonholed in terms of your investments. Instead, you can think outside of the box using these kinds of strategies. And by doing so, you could find yourselves with the best of both worlds. That's all we have time for today, but please do your own due diligence before making any investment decisions. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar.